This week in the Boardroom, brought to you by corporate board member and host NYSE Euronext, along with governance knowledge partners, the Center for Audit Quality, and Grant Thornton, and contributing partners, National Investor Relations Institute, and the Society of Corporate Secretaries and Governance Professionals.
Welcome to this edition of This Week in the Boardroom. I'm TK Kerstetter with Corporate Board Member, and today we are going to film part two of what has started to be a very interesting discussion with our guest Rick Ketchum, who's the chairman and CEO of FINRA, the Financial Industry Regulatory Authority. And those of you who have not seen the first show, first of all, we welcome you to go back and view part one. But let me just give you the background for Rick here, just so you know what we're talking about. In addition to serving as the CEO of FINRA, Rick had been the CEO prior to this of the New York's NYSE regulation. Prior to that, served with Citibank. Prior to that, was the president of NASDAQ stock market for a while, also president of NASD. And as we spoke about last week, did his foundational work at the 14 years at the SEC, most of that under the director of market regulation. So last week, Rick, welcome, first of all.
Thank you. Great to be back.
Last week, we talked about the board of directors, mostly, a little bit about FINRA. This week, we want to talk about the markets. That is sort of your bag, okay? And some would say your responsibility, at least in part, okay? So much is going on today. And, you know, we look, when we talk about markets, we think of sort of big events. And one of the big events would be examples, the flash crash is the kind of event that sends shock waves across and people get worried. You see, you know, blips with NASDAQ and the NYSE in certain, you know, situations. So I guess I'm most curious to have you talk about the markets, market structure, and sort of what you see going forward, and really provide some information to our board viewers on why that's particularly relevant to them.
Sure, absolutely, TK. And I know many of your viewers had legitimate concerns at the time of the flash crash, and they should have. Let me set that up, tell you why I think they should feel better today, and then we can talk more about some of the market structure issues. First, market structure has changed dramatically, as all your viewers are aware of. We've moved from an environment where most trading occurred on the floor of the New York Stock Exchange physically or in the NASDAQ stock market to an environment where trading is fragmented. That's a result of a variety of things, technology advances and SEC regulatory determinations that encourage competition. But the result is we now have multiple exchanges that share the order flow and the pricing activity in the marketplace. We have activity away from the exchanges that is permitted, that is a significant percentage of the overall trading activity. And that has created an environment where electronic trading thrives. And in that type of environment, what we saw with the flash crash was something that was very troubling. Effectively, you have two types of strategies with respect to high-frequency trading activity and the algorithms that drive that activity, and they're not really mysteries. One set of those provides similar liquidity-providing activity to market makers looking for small profits on a regular basis. The other activity is more speculative in nature, responding to meaningful price changes. When you have an event that kicks off significant price movements, usually coming from the futures market into the equity markets, that's a time where two things can happen to algorithms that aren't good. The speculative algorithms suddenly accelerate and start selling more stock. At the same time, the entities that usually are providing liquidity on the other side look at things that the algorithm is not trained to understand and is not designed to understand. The net effect is often the algorithms remove themselves from the playing field until a human being can take a look and determine that Western civilization isn't ending. That's a bad situation. It creates a huge gap in liquidity. It resulted, along with some other technical things that aren't worth going in here, in the huge price gaps that we saw and the dramatic volatility that we saw with respect to very viable, very meaningful companies trading at ridiculously low prices and then moving back into more reasonable trading range very, very quickly. Not good for investor confidence, not the way markets should operate. People should feel better with the responses that the exchange and FINRA have taken to that, working with the SEC. First, you have to deal with the reality in electronic markets. There's the potential for this gap. So we put in single stock circuit breakers to ensure that when that type of price movement occurs in that type of gap, there's a chance to take a breath. That allows the marketplace to resend in bids, recognize, understand what the news is that may have caused the initial price environment, and with that, provide far more protection with respect to market-wide volatility. Still creates the risk with respect to the one error trade that can go way down in a marketplace, and we've still seen that with respect to individual securities, and still risks in the first few minutes of the day, as we've seen with respect to error transactions, among those dramatically impacting one large firm, Knight Securities. We're about to move to a second stage that is called limit up, limit down. That you don't need to know the details. What you need to know is that it builds an environment first where you won't have a single error trade that will print way out of range. It will be blocked from occurring beyond a few percentage points away from the market. And the restrictions and price parameters will be in there all day long very quickly, not just starting at quarter 10. All that creates a marketplace that may not be perfect from a market structure standpoint, but no longer poses the risk of the sort of profound and destabilizing volatility that we saw before when there weren't events that really justified it. People should feel better about that. It's only a first step, but people should feel better about it.
Well, lately it always seems that they're wondering what's around the corner, with the markets or with even financial institutions. Sometimes there's that concern. We had an announcement not too long ago here at the New York Stock Exchange, and I should report that corporate board member is owned by the New York Stock Exchange, so we are limited in what we can talk about relative to the announcement of the ICE exchange acquiring the New York Stock Exchange. But the question for you is, that's a big event. I mean, it's a big event for an organization that, again, was at one point in time certainly was the market leader. But what, from your vantage point, what does an acquisition like that mean? And will it have any effect on the markets or the market structure?
Well, as somebody who spent several years at the New York Stock Exchange and deeply enjoyed it, I couldn't agree more. It is a big event. I don't think it will have dramatic changes in the market structure, certainly not in the near term. The economics and the basis for this deal, very articulately stated by Duncan Niederauer, is pretty obvious. The areas of growth with respect to equity-related products comes in the derivative area and is likely to come in the swaps area as those become standardized, or much of it becomes standardized products that are traded either in exchanges or exchange-like facilities with clearing. So having a greater exposure from the standpoint of derivative markets makes sense. Operating at New York Stock Exchange with Euronext had that exposure to some degree. The merger of these two organizations, I think, gives much greater balance from the standpoint of derivative upside opportunity. The other piece is you really can't think of equities without thinking about the trading opportunities and activities that exist from the options and futures markets anymore. And it makes sense for the enterprises to be operating together. Now, people might ask, is that going to result in bigger market structure changes? Certainly, we've seen the futures markets become more and more electronic, in particular the ICE markets. I think likely, certainly for the near time, that's not going to be the real case at the New York Stock Exchange. Obviously, the floor of the exchange is very different than it was before. Its role particularly focused at the opening, at the close, and in times when there's market news. But that role, I think the exchange still feels as an important differentiator. And unlike a futures market environment, the confidence of issuers in that market to some degree relates to those differentiators. I'm not saying what market structure is right or wrong, but I don't believe that simply this merger is likely to reach a decision different than the exchange's decision already to maintain a hybrid market that substantially depends on electronic trading, but also depends on floor activity.
It's hard for us to talk about equity markets, particularly these last couple of years, without addressing what seems to be the most popular topics, and that's what they call dark pools and really the high frequency trading. Can you translate that into layman's terms, if you will, just why those are such big issues, particularly I think the definition of dark pools and why that's such an issue?
Sure, and it's important to translate because it's important to focus on what may be legitimate market structure issues, but really is not per se sinister in the way some people fear it is. High frequency trading is simply electronic trading using algorithms. It involves strategies that many of which are liquidity providing, some of which are speculative. It's neither good nor bad, but it reflects strategies that are not very different, just much higher speed than existed before. What you need is strong surveillance to make sure that it doesn't involve a manipulative activity or gaming activity, and that's our role, and it's a role we're absolutely determined to play, and I think we play it quite well. Dark pools are really two different things that your audience should be thinking about. The traditional dark pool is a matter of providing an environment for large trades and for institutional investors to find the other side of large trades without having the same liquidity impact they may have splitting it up and selling that up in large amounts of transactions in the orderly market. That, I think, is inherently logical and doesn't really raise any big policy issues. The expansion of dark pools relates to the execution of small trades, and most retail order flow, most customer order flow is now executed by large firms, either their own customers or with respect to transactions, upstairs away from exchanges, and then that flow then comes down to the exchanges from those initial executions. That I don't think per se creates an efficiency or pricing problem. I don't think people need to panic about it, but it raises some legitimate questions. The SEC put out a concept release with it. We've seen activity and reaction in Europe and Canada. I think the questions about exactly how that activity relates and what responsibilities people should have with respect to the trading of small orders away from an exchange is going to continue to be a subject of significant conversation in the next couple of years.
Well, as usual, when we have on interesting guests, Rick, we run out of time way too early, but there is a final question that I want to ask you to sort of summarize this, and that is, when you look at the equity markets, tell me a trend that sort of concerns you a little bit, looking forward, and then tell me a trend that sort of gives you great comfort that everything's moving in the right direction.
Well, I think the concerning piece is that we have to make sure that the results of encouraging competition from the standpoint of greater fragmentation and the activity occurring away from exchange systems is rationalized in a way that's fair and balanced. I think what makes me feel better is that I think there have been significant steps in that direction. Surveillance is far better than it is before. There are greater obligations with respect to firms from a supervisory standpoint when they introduce algorithmic electronic trading from persons that aren't broker-dealers. And the basic environment has, because of competition, resulted in narrower spreads, narrower price impact, and really a marketplace that's quite efficient in normal times for customers. We just need to make sure that it is as efficient and effective in very volatile times as it is in normal times, and that investors receive what they deserve in all market environments. And that, I think, deserves more attention. But as I said from your first question, people ought to feel pretty good about the fact we're in a much more stable environment now than we were 2-3 years ago with the flash crash.
Rick Ketchum, Chairman, CEO of FINRA. What a pleasure to have you on, and we won't wait so long to have you back again so you can give us an update.
It's always a delight to be with you, TK.
Well, thanks again for joining us. And that will conclude this edition of This Week in the Boardroom. We hope you enjoyed the show. Again, if you missed part one, you can go back and see that at boardmember.com. We hope that you'll join us next week when we take a look at another critical topic that will help you be a better board member and committee member. And we will see you then.
join us again next week for This Week in the Boardroom, brought to you by Corporate Board Member and host NYSE Euronext, along with governance knowledge partners, the Center for Audit Quality and Grant Thornton, and contributing partners, National Investor Relations Institute and the Society of Corporate Secretaries and Governance Professionals.